Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time.
Hey guys.
Welcome, everyone. Welcome to another Lunch and Learn session. I'm Mark Triplett.
Troy Westendorf.
And during our Lunch and Learn sessions, we try to cover topics that will be a little food for thought for you, a little bread for the head, share some ideas in a short format setting. And we spend no more than about 15 minutes covering these topics. And we encourage you, if you have questions afterwards, to reach out to us. Now, today, specifically, we're talking about three things. What actually happens when you contribute money to a traditional IRA, and why it's not necessarily going to result or lead to a tax savings as you might be led to believe. And then lastly, how to determine whether you should contribute to a traditional IRA or not. So, Troy, those are the things we're going to cover. And what really prompted this is we're coming into tax season. Even our CPA, Chad Harrison, has been guilty of saying, hey, these folks need to contribute to an IRA. It'll save them money on taxes. And we always have to remind him that just because you contribute to an IRA doesn't necessarily mean or equate to saving money on taxes.
Right.
Yeah. So what actually happens when you contribute to an IRA?
Well, so the IRA is set up for an individual retirement arrangement. It's set up for a tax. It's supposed to be tax favored. So I just had a conversation yesterday, actually, with a person in a 401k. Well, what's the difference between a 401k and an IRA? Really similar, right? You get tax favored up front. So as you're putting your contributions in, it's tax favored. And as you said with Chad, it's, do we take the tax favored benefit now, or do we do something different? Are we doing taxes now, saving on those tax dollars, or is it going to benefit us in the future, taxes higher or lower? And those are some of the conversations we have to have as well.
You just said something too. I want to make sure folks that caught this or did not catch this. You said an IRA is an individual retirement arrangement,
Right?
Not an individual retirement account. Interestingly, if you look up the IRS's website and you look at the tax code, the IRA actually does stand for individual retirement arrangement. Now, you'll see articles online and even in IRS publications that refer to it on occasion to an account, but that's the actual tax code the way it's written.
Right.
So an individual retirement arrangement would be your traditional IRA, SEP IRA, simple IRA, and basically you're getting a tax deduction on the way in. That's why people contribute to these pre-tax accounts. They're getting a tax deduction. So when I make a contribution to an IRA, say it's 2021, but I make a contribution for 2020. Looking back, I meet with my CPA. My CPA says, "Well, you'll save money if you contribute to an IRA for 2020. It'll save you money on your taxes." What they're really saying is that it's going to reduce your tax liability for 2021 if you do that. It doesn't equate to a tax savings. Really, what you're doing is you're kicking the can down the road.
Yep.
You're deferring the taxes that you would have paid today at today's tax rates, and you're kicking that can down the road. And when you make distributions in the future, you're going to have to settle up with the IRS, because traditional IRAs and SEP IRAs and simple IRAs and 401ks, for that matter, those tax deferred accounts are always IOUs to the IRS. Always.
Right.
So if you're the owner of the IRA and you make distributions, you pay taxes. If you're the owner of the IRA and you pass away and you leave that IRA to a beneficiary, they're responsible for paying taxes. Taxes will always be due. So the question then really becomes, am I going to be better off taking the tax deferral? Am I in a lower tax rate today than I will be in the future, or a higher tax rate today than I will be in the future? That's really what it's going to come down to. If you defer taxes today in a 12% tax bracket, and later on in retirement, you're likely to be in a situation where maybe you'd be in what is today the 22% tax bracket. because either you have to make distributions from your pre-tax accounts to maintain your standard of living adjusted for inflation, or you're forced to take those distributions at age 72 because the government makes you take those distributions. And the older you get, the larger distributions you're forced to take. Those are called requirement of distributions. At some point, you could be pushed into a higher tax bracket. We also have to look at the fact that we're still living under the Tax Cuts and Jobs Act. Now, the administration today, the Biden administration, and quite a few in Congress would like to roll back those Tax Cuts and Jobs Act tax rate reductions. And that's possible. So we might see that happen sooner than later. But if you're in a 12% bracket today, you defer taxes. And even if we go back to what the tax rates were before, the 12% used to be 15.
Right.
If you defer at 12 and you distribute at 15, that's not a tax savings. So if I'm not correct, right? I just paid 3% more tax.
Right.
So sometimes it might make sense to pay the taxes now. Now, if you're highly compensated, you're in a 24 or even a 28% tax bracket or higher today, and the likelihood that when you actually do retire and you start distributing those dollars out to supplement your retirement, that you're in a lower tax bracket where your effective tax rate is lower, then maybe it can equate to a tax savings. But don't let somebody tell you that you're saving taxes by contributing to an IRA without actually doing the work to make that analysis.
Right.
Just because you defer taxes on your 2020 tax bill or 2021 going forward doesn't equate necessarily to a tax savings.
Right.
That all depends on what your tax rate is going to be in the future.
And that's always the tough one for the client sitting across the table from the CPA when he says you have a $5,000 tax bill, but if you contribute to an IRA of $1,800, this is what you can save on taxes.
Yeah.
So they think, okay, well, if I can save that on taxes, I'll just save it and pay myself and do an IRA for $1,800.
Let's look at an example of where it would be a tax savings. Okay. So for example, let's say Mr. and Mrs. Smith, they retired at the end of 2020. So Mr. and Mrs. Smith had a pretty sizable income because they were both working. Let's say they were making $150,000 a year, not spending all of it, maybe living on half of it, but socking some of that money away for their future. Okay. Now they're both retired in 2021, right? So their income's going to go down because they're only living off of about $75,000. So between Social Security, pension, distributions from retirement accounts, their income's going to be in that $75,000 range, not $150,000. Now, if they decided to contribute each of them to an IRA, and if they're over 50, then they can contribute. If they're retiring, they're probably over 50. They can contribute to the IRA at the rate of $7,000 a year, $6,000 plus a $1,000 catch up times 2, for each one of them. That's $14,000. Now, at $150,000, they're in a much higher tax bracket than they will be when they're distributing enough to maintain a $75,000 a year lifestyle. That would be a tax savings. I'm deferring 2020 tax rates at a much higher tax rate, and I'm going to distribute that later at a lower tax rate. Even if they did it immediately, they contribute it for 2020, they immediately distribute that money to maintain their lifestyle in 2021. That's a tax savings because they saved money at a higher rate, a higher tax rate, and they're distributing it at a lower tax rate. That's an immediate example where that might make sense. But it can also be the opposite of that, where somebody is maybe in a lower tax rate. Let's say they're retired 2 years ago, their income was lower.
Right.
Maybe they had a part-time job. They have the ability to contribute to an IRA, but they're going to be in a higher tax rate in the future because we see in our planning program that when they start distributing money out of their pre-tax accounts 10 years from now, 15 years from now, it's going to push them into a higher tax bracket. They may not be better off contributing to a traditional IRA. They might want to think of another route to go. Either save money in an after-tax brokerage account where they pay capital gains and dividends on the gains, or maybe a Roth IRA if they're eligible to do so.
Right.
So there are different ways to slice this, but don't just take somebody's word for it that you're going to get a tax savings by contributing to an IRA, because that may not be the case.
Or assume that you're going to spend less in retirement. We rarely see that when we do our plans. So when we talk about all this stuff, we talk about the tax brackets, and the reason we can diagnose this and really dig deep in it is because of the program we use for Retirement Analyzer, which our clients that have went through our process know how we do this. but rarely do we ever see someone that has or wants to spend less in retirement.
I think the way we would typically phrase that is we've never run across anybody who has told us that after they transition from their working years to their post-working years, that they want their lifestyle to decrease.
Right. Yeah.
Right.
Yeah. That's good. Yeah.
Now, what they're making in terms of income might go down, but they're generally their lifestyle, their spending habits don't go down.
No.
In fact, they'll often increase because now they're accounting for taxes and health insurance that maybe they weren't accounting for in the past because those are coming out pre-tax out of their employer's paycheck. They're working, earning a living, they're taking home a certain amount of money that they're accustomed to on a monthly basis. And then when they retire, all of a sudden they're shocked that the amount of money they need to live off of might be actually greater than that, might be 20% more because they're now paying for health insurance out of their pocket as opposed to having it come out of their paycheck. And they have taxes to reconcile with as they distribute money out of their pre-tax accounts like IRAs and 401ks. Right. I'd say the biggest trip is when folks have the majority of their dollars in pre-tax accounts like IRAs, 401ks, and IOs, the IRS. And we look deep into retirement, 75, 80 years of age, and they're shocked at the amount of money that is being forced out through required distributions, even though they don't want to take it. And that's a product of actually retiring with too much pre-tax money. You can actually be too tax efficient. You can be too tax efficient early on and wind up with a whole lot of taxable savings, retirement savings that can really create an imbalance in the tax equilibrium. I mean, you could be really tax efficient now and feel really great about yourself. And then in your late 80s go, what happened? Why am I paying so much in taxes? Well, it's because you kept deferring. And we really have to ask ourselves, with the amount of stimulus spending on top of a ballooning budget already, are tax rates really likely to go down or are tax rates really likely to go up? And if you believe that tax rates are likely to go up, just saving into a pre-tax account doesn't necessarily equate to a tax savings. No. And it doesn't mean that some folks shouldn't. There are cases where it does make sense to save into pre-tax accounts, but I think this time of year we hear that over and over, that I'm saving money by contributing to an IRA. Well, are you really saving money? Or are you just deferring the taxes and reducing your tax bill for the past year? And that's the difference between working with a tax preparer and a tax planner. And we've said this before. Our tax planner is looking down the highway. He's looking through the windshield, looking miles down the road, where tax preparers are often looking in the rearview mirror. They're looking backwards and saying, can I save you taxes over the last year?
Yeah, right.
Rather than, can I save you taxes 10 years from now? Can I save you taxes 15 years from now? Can I save your heirs from paying enormous tax bills when they inherit the pre-tax accounts that you leave them? And really, tax planning is a pretty critical part of our planning here.
And I think you hit it right on the head there with the heirs, because sometimes we see clients that they're not running of dollars per se. The tax hit is going to be on their heirs.
Correct.
And I think another one, Mark, that you said that would be great for a lunch and learn is being too tax efficient early. I won't say many, but we've ran into clients that are spending their savings, spending their bank account dollars before going to their IRAs, thinking that they're saving on taxes. In reality, they should probably be spending some of those IRA dollars now instead of taking all of their bank and their savings dollars to pay for their living expenses.
Absolutely. What you're describing there, folks that are spending money out of their savings accounts and their bank accounts because they don't have to pay taxes on that money. They're not earning anything in it anyway. Right. It's just sitting there. Right. So they're spending their cash, or they're advised to spend their Roth IRA money because that's tax free. Yeah. And we'll continue to defer the pre-tax accounts because we don't want to pay taxes right now. So they end up with a tax bill that's near zero or in the 10% bracket. Right, because they're spending they're spending all the tax advantage dollars rather than blending it out, and then they're going to end up in much higher tax rates later on because they basically spent all of their tax free or tax advantage money rather than blending that out. I mean, is it better to stay in a 12 to 22% bracket the entire time, create equilibrium, or is it better to be at a very, very low tax bracket for a few years, only to end up in the 24 or 28 later on, and have this big imbalance. And we're just using current tax rates. We're not talking about what happens when those tax rates go up in the future.
Right.
So anyway, so just know that a contribution to an IRA doesn't necessarily equate to tax savings.
Right.
It really depends on what is the tax rate today, what are you deferring at, and what are you likely to be distributing that money at? What tax rate are you likely to be distributing that money at later on? That really determines whether it's actually going to be a tax savings or not. And we can't predict the future necessarily, what tax rates will look like in the future. But through our planning program, we can often look into the future and say, you're likely to be pushing yourself into a higher tax bracket because you're building up so much pre-tax income. It's going to come back to haunt you later on. And that's how we're able to guide folks on making those type of decisions.
Absolutely.
Anyway, so hopefully this was informative to you. Hopefully you found some value. Next week, we're actually going to be covering whether or not you should be contributing to a traditional IRA or a Roth IRA. So we'll talk about the pros and the cons of both a traditional IRA as well as a Roth IRA, and help folks make a decision as to whether they should be contributing to the traditional IRA or Roth IRA. So hopefully you can join us for that. That is on the 23rd, so February 23rd, 2 weeks from now, on Tuesday at noon, 12 noon. Until then, remember that every dollar has a purpose.
Every dollar has a timeline.
And your goal should be to retire with purpose and do it on time.
Absolutely.
Thanks for joining us, everyone.
Take care, guys.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.